Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Comcast Corporation, ticker CMCSA. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this market cap is $173 billion, $257 billion enterprise value. That suggests an astronomical amount of debt on this business, 50, 60, 70 billion dollars in debt. You're going to be extremely leveraged with that much debt. They operate in the media industry. I'm actually a customer of Comcast, some of my subsidiary work, and it operates in the cable communications, media studios, theme parks, and Sky segments. So they have various brands for voice, wireless, residential, business customers under Xfinity brand. They have NBC Universal, film and studio division, theme parks, in Universal theme parks, and they have Sky as well, operating mostly overseas. So beta of 0.98, share turnover 130%. So when we thinking quality, again, we want to look at their earnings history. They looks like they have 1 year of losses in the last 20 years and 19 straight years of profitability since 2003. So they lost money in 2002, but since 2003, they have been profitable every year. That's a plus mark in my sign for business quality. In addition, you have seen steadily improving returns on time. That means the incremental return on capital is higher than the legacy return on capital that you see here. So although we see, 5, 6, 7% returns on capital, we see that those numbers are getting better over time, which suggests that maybe the incremental returns on capital exceed 7%. So good sign as well, because 5, 7% returns are simply not good enough on their own. You really want those to be double digits. You want to see this getting above that 10% line. But it might mean that incremental returns are already over that 10% line, and we care about the future, not the past. So that could be a really good sign for the future. We could look 10 years from now, and this could all be in the double digits. So positive sign for business quality there. Now, 10-year median returns. Again, return on invested capital of 7.2% is too low for me to really be excited, but they do hit the 15% number that I like to see it on return on equity. Normally, you need a 10% return on invested capital to hit something like a 15% return on equity. But as I said up above, you have so much debt on this business that you're likely hitting that due to a high amount of leverage. Now, what's interesting here is when we talk about valuation, a PE of 12 is actually very attractive. Anytime the PE is below 15, I get excited. I only really want to pay a PE of 15 or less for most businesses, and yet you have mostly signs of a high quality business, somewhat low returns with this return on capital numbers, and to get that at a PE of 12 is actually quite attractive. When you combine that with revenue growth of 7% and EPS growth of 15%, PE of 12 becomes even more attractive. So we're looking right now at probably fair value to undervalued for my valuation of this company from this first look so far. Now, I did say that you're having improving returns on invested capital over time. Now, where's that coming from? Part of it is coming from this fact that the revenue growth is exceeding asset growth by about 2% a year. That means that you're going to continue to get better and better returns because you're keeping your asset growth down. You're growing your revenue, free cash flow, and EPS substantially faster than your assets. If you can sustain that over a long period of time, you're going to see high incremental returns on capital that's going to flow to the bottom line. That's very, very good. In addition, another positive sign for high quality is you have a very high gross profit margin of 69%. It's fairly stable between that 68-69% range over the last decade. So pretty good returns, pretty high reliability, and they're having some pricing power here. That's what it's demonstrating for you. Now, you've been able to grow EPS at 15% a year. You've gone from $1.15 per share to $3 per share, so almost a tripling over the course of a decade, but a little less. That's very attractive returns over time. In addition, you've been paying a dividend. You've almost tripled your dividend as well from 33 cents. You basically tripled your dividend from 33 cents per share to $1 per share. That's very attractive. So you're growing your dividend even faster than your EPS. You can't do that all the time, but you can clearly see a strong double-digit growth in your dividend over time. Very, very positive that you've been able to sustain this revenue growth despite growing your dividend rapidly. So attractive numbers so far from what we can see on Comcast. If you're enjoying this video, don't forget to like and subscribe below. You hit that subscribe button and you ring the bell so you can get notifications as I upload new videos each and every week. Right now I'm targeting 3 videos a week. I'm going through every company in the S&P 500. We're going to try and do Monday, Wednesday, Friday, but if you want to make sure that you're the first to know about those videos, you got to ring that bell to get notified as I upload new videos each and every week. Let's go to the income statement. Now, income statement, you can clearly see, again, there's a big gap between revenue and cost of goods sold. That's because there's that big pricing power that they have in there. You've seen they've been able to grow their gross profit line from $42 billion to $77 billion, but they've hardly had to grow their SG&A. They've only seen a $2 to $3, maybe a $3 billion increase in SG&A. Now, there has been a large growth in other operating expenses. You'd really want to understand what that is when if you're gonna own this business, because that is the substantial source of your expenses in this business. So whatever other operating expenses are, they're clearly growing with the revenue line. They're clearly a real expense here you need to take into account. Now, one of the other things I like to see is that they are buying back shares. You can see it looks like every single year the share count is lower than the year before. So they have a clear and steady buyback program. It does look like it's leveled out a little bit over the last 5 years. So I would have some concern about what's going on in the 5 years. Why did they change capital allocation in 2018? But you do have a clear buyback program, which has boosted your EPS growth faster than your revenue growth. You like to see that, though. Balance sheet. You do see that their PP&E has basically doubled over time. They've had to grow from $27 billion in PP&E to $54 billion in PP&E. They've been making acquisitions. You can see a big growth in acquisitions from 2017 to 2018 because you have that big jump in goodwill and jump in intangible assets as well. So in addition to the PP&E, they're making big acquisitions to fund this growth to that level. Now, you see this absolutely humongous growth in long-term debt. You're at $92 billion in long-term debt. You started the decade at $37 billion in long-term debt versus only $8 billion in cash. So this is an extremely leveraged business. You have more long-term debt than you do have PP&E. So you're definitely running this business using debt, and that's a substantial part of the operating plan for the business. You can clearly see that when you break it down into that level. So if you're going to invest here, you need to be very comfortable owning a leveraged business. Now, the cash flow, you can see there's a substantial amount of depreciation every year, basically equaling the net income. There's a lot of reinvestment risk in this business. They're having to reinvest over and over again in new plant and property equipment. It's clearly capital intensive. I don't really like capital intensive businesses, but it appears that they're earning their cost of capital. They do have those returns increasing over time, so they're making it work. But you need to be aware they're going to be investing a substantial portion of their cash from operations into this business. I would definitely value it based on net income and not from cash from operations, because you're seeing that the depreciation is outpacing the PP&E expenses each and every year. So it's going up and up and up and up. And so these are real expenses that they're spending on capital. They're not simply investments. They are a lot of maintenance expenses, and you see that in the depreciation line item. You do see that they've stopped buying back stock every year, which I really don't like to see, especially because they're paying over $1 billion in stock-based compensation every year still. So your share count's going to start rising, and that is a bleaker future than I'd like to see. They've clearly decided that they're going to continue to pay dividends, but they're paying a substantial amount of dividends. They've stopped the buybacks. I don't really like how that has changed. So before I got to this point, I was actually really excited, but I don't really like the change in capital allocation. I would want to see more buybacks. I want to see the stock-based compensation number coming down, or at least being offset by buybacks, because it's going to change the whole dynamic. One of the things that makes this company really interesting is the fact that you've grown your EPS substantially faster than revenue over time. You're growing your revenue faster than assets. But this will reverse. If your EPS will start growing slower than your revenue, if you continue this idea of now you're going to start diluting shareholders. Part of the driver of this big difference was that they were buying back shares. And if they're going from buying back shares to issuing shares, you're going to see the reverse happen in the future, and that changes the whole dynamic of investing in this business. So for me, until I have a better understanding of the capital allocation plans and why they changed in 2018, I would pass on Comcast Corp, which is not about valuation. It's all about the management. The valuation appears cheap. PE of 12 with this level of growth is either fair value or cheap for a business like this. The returns are clearly getting better over time. You do have a nice, strong history here. You do have a stable, strong business. It is profitable. It does appear to be high quality. But for me, I need both value, quality, and good capital allocation. And Comcast fails the capital allocation piece for me. So it won't go on my watch list, but there's a lot of stuff to like here with Comcast. And so if it's the type of business you're interested in, I encourage you to take a look, do your own research. So if you like this video, please hit that like button. If you're learning from my videos, you need to be a subscriber. I'm uploading 3 to 5 videos a week. All right, now I'm aiming for Monday, Wednesday, Friday, putting out new stock ideas over and over and over again. So subscribe, ring that bell. You can get notified as I upload new videos each and every week. If you like how I study these companies, if you like having this breakdown of all this data, revenue, gross profit, returns on invested capital, and you want to do analysis just like this, then use quickfs.net. You can sign up from the link in my show notes. That's my affiliate link. If you sign up for free with that link, they will know that I sent you to them, and then I get a cut of any future revenue that they might earn from a subscription for you. So you can sign up for free, no risk. It doesn't cost you anything to use my affiliate link. It's just a way of rewarding me for giving you this great content. So if you enjoy my content, don't forget to subscribe using my link, and I would appreciate that. Thank you for listening, and until next time, stop paying fees, start building wealth.